While viewing this video lesson, hit pause and rewind to review unclear material and jot down your questions as they occur. At the end of the video, you'll be invited to our Q&A discussion forum to post your questions and thoughts with your peer students and instructor. Chapter 8 continues from Chapter 7 with a focus on the investor's perspective of risk and return. Chapter 7 was about determining past performance, but Chapter 8 shifts to future projections and predictions. Our key term is the expected return. What return should an investor expect in the future based on past performance? If we look at the history of the economy, or a market segment, or a specific company, we know it cycles through boom and bust, bear and bull years, expansion and recession. While not accurately predictable, it is expected that these historical cycles will repeat. We also know that different market segments react differently during the cycle. Luxury items, such as new cars and cruise ship vacations, they do well in the boom years, while necessities like health care and grocery foods are stable, whether in a boom or a bust. Still other items, such as government bonds and precious metals, like gold and silver, they tend to soar during the bust years. Gather enough historical data, and we can apply our expected return formula to project the likely return for a stock. We calculate how our company performs during different economic periods, such as boom, normal, and bust. We also have economists calculate probabilities for being in each of those economic states. Our chapter reading and this module's demonstration videos explain how the formula works, but our goal is a single value, the expected return for how we expect the stock to perform for the next few years. A typical and smart investor doesn't just invest in one stock or one market. They diversify with an investment portfolio.
How to build a portfolio. Presented by WallStreetSurvivor.com. Before you build a portfolio, you have to ask yourself two questions. 1. What is your investment horizon? Or in other words, how long do you have to invest? For example, a 25-year-old guy is looking to make some quick cash to buy a new car for next week. That timeline is pretty darn short. On the other hand, if he was saving for retirement, that timeline would be much longer. The second question you have to ask yourself is, what is your risk tolerance, or how much risk are you willing to incur? For example, a risky company would be a biotech company that is awaiting FDA approval for a new drug that could cure cancer. If the approval goes through, the investor could stand to make a fortune. Otherwise, his investment would be worthless. The opposite would be investing in something relatively safe like a utility company. Most of these companies have been around for a while and have shown stable earnings and consistent dividend payout. The investor probably won't make a lot of money, but he probably won't lose much either. You use time horizon and risk tolerance together to create an investment strategy. There are dozens of investment strategies that you can use to build your portfolio. Here's a couple. A diversified portfolio consists of stocks from different industries, sectors, and locations. By not putting all your eggs in one basket, you can reduce your risk. The opposite of diversification is industry-specific investing. That means buying stocks from only one industry. You would use this strategy if you had specific knowledge of the industry, you felt the industry was about to take off, or you felt the industry was the safest bet. Here's Susie. Susie is a freshman at college and needs to choose her classes for the upcoming semester. But how will she decide what course load is best for her? If Susie was undecided about her career path, she would choose classes across different disciplines and faculties. If she discovers her art skills are poor, her other courses will balance out her GPA. This is a lot like diversification. If Susie knew for certain that she wanted to go into accounting, she would fill her course load with only accounting classes. This is a lot like industry-specific investing. Diversification and industry investing are just two of many portfolio strategies. To learn more about them and other strategies like blue chip, penny stocks, speculative, and growth and value investing, check out WallStreetSurvivor.com.
We learned earlier how to calculate the expected return for a specific stock. But with a portfolio, or collection of different stocks and investments, we need to calculate a weighted average to determine the expected return for an entire portfolio. Again, our chapter reading and this module's demonstration videos explain how the formula works. It is also common with portfolio returns, which is a weighted average, to also calculate the variance in standard deviation as we attempt to assess the risk of that portfolio. Our discussion on portfolios and stocks has centered on the expected return, but an investor also needs to consider volatility. How does the stock or portfolio react during economic changes, say as it moves from boom to bust? We use the beta factor to communicate this.
Beta is a historical measure of the risk an investor is exposed to by holding a particular stock or portfolio as compared to the market as a whole. The beta of a share in Casey's Corn Company is 0.5. This means that Casey's has historically been 50% less volatile than the market. So if the market moves up by 10%, Casey's stock will only appreciate 5%. If the market declines by 2%, Casey's corn will lose only 1% of its value. The change in market value is multiplied by a stock's beta to estimate its movement. The risk and reward trade-off suggests that high beta stocks have a greater risk and, as a result, a higher expected return. If Casey's has a beta of 1.5, it will theoretically be 50% more volatile than the market. This means it is likely to gain 15% when the market gains 10% and lose 3% when the market drops 2%. A stock with a beta of 1 would move in tandem with the wider market. Both low and high beta stocks have their place in a portfolio. Low beta stocks are stable. Their performance is weaker than the market as a whole when the stock market is strong, but when the markets drop, these stocks usually experience less dramatic declines. High beta stocks are the opposite. They outperform when the market's strong and fall further when the market declines. However, it is important to remember that beta is a historical measurement, so it can't predict the future. The beta of a stock will change as more historical data points are added, and many such events will prove to be entirely unpredictable. Beta is a useful measure for investors because it helps them create portfolios that match their risk tolerance.
A company's beta is well known. It's published and available from many financial sources, such as Google Finance and Morningstar. A stock beta is nothing more than the ratio of the stock's risk premium over the market's risk premium, shown in red. Hey, a quick review from the earlier video. What is the risk premium? It's nothing more than the total or nominal return minus the risk-free return, which generally is our U.S. Treasury bill rate. Notice I've highlighted in red the market's beta. That's because we learned from the video and Chapter 8 that by definition, the market's beta must be 1. Change the market beta to 1 and apply a little algebra, and we have our capital asset pricing model, or CAPM. This is our alternative formula for calculating a stock's expected return. Looks very different from the simple formula we presented earlier. Both are valid methods, and they will give you different answers. Personally, if I have sufficient data, I use both methods and average the results. Your homework 3 includes problems from Chapter 8. Posted in this module section are some optional videos where I demonstrate using Excel to solve 3 typical problems from Chapter 8. If you would like to explore this topic, share your experiences, or get clarification on the material presented, just join the Q&A discussion forum linked in the module section.